Today, we're going to hear an inspiring story of a former aerospace engineer turned multifamily real estate investor towards his journey of becoming financially free and the importance of prioritizing family first in your career decisions. All this and more with my guest, Chad Sutton, coming up.
Welcome to the Wealth Through Real Estate Investing Podcast, your source for real-world strategies focused on creating long-term wealth, cash flow, and financial freedom through real estate. Through guidance, tips, and stories of highly successful real estate investors and thought leaders, we provide you the tools to succeed and to reach the lifestyle you always wanted. And now, your host, Dwaine Clarke.
Hello and welcome back to the Wealth of Real Estate Investing Show. This is your host, Dwaine Clarke, and today we have Chad Sutton. He's a managing partner and head of acquisitions at Quattro Capital. I apologize if I mispronounced that. Quattro Capital. Chad, thank you so much for joining us on the show, and how you doing, my friend?
Hey, Dwaine, I'm doing well. Happy to be here. It is a rainy day here in Nashville, Tennessee, but all things are shining all rays are shining in the world of real estate.
I like that. That's a good segue into our speech. So I really appreciate you taking the time, like I had mentioned before we started recording, is really resonate with your background, because that's kind of like, probably what everyone wants is more time with their family and things that they want to do, have a life by design. And I'm, like that you have, you went from a big 6-figure job to running your own business and, all of the risks that goes along with that. But you knew that that was kind of the way that's just going to support your family and provide a lifestyle that you like. But for people who are not familiar with your background and your story, can you kind of talk to our audience on how you got started in real estate and what your current focus is on?
Yeah, absolutely, Dwaine. So it's quite a long story. I'll try to make it short, right? But, I'm actually a third generation real estate investor. I didn't know I was for a long time, right? My family actually was in single family real estate at my grandparents' level, right? So they started, and acquired about 75 multifamily home or single family homes after leaving corporate America themselves. And, I worked on them as a kid. I didn't quite really know what they were doing with it. Definitely didn't understand it was a wealth vehicle at the time. I just knew it was a way to get, extra income in the summer. Right.
Mm-hmm.
So I went on my merry little way and went down the corporate America track, followed the American dream, which I have found the formula to be broken for. I went to school. I treated it like my job, as I was told, so that I could get a good job. I could get, work for a large Fortune 50 company. I went to school to become an engineer, one of those top-notch professions that you're told to go into, right? And because I was I was good with numbers, naturally, engineering was the place to go, right? And so I spent much of my early career designing, I actually worked for NASA for a little while back when we were still flying the space shuttle. So I got to play with rockets a little bit. Then I spent the bulk of my engineering career designing aircraft engines on many of the, your typical Southwest Airlines flights, right? Things like commercial airliners, spent a lot of time doing that work. And, Dwaine, have you ever looked down and said, I'm stuck? Right. I've gotten myself so pigeonholed, and I'm doing something that's so specific, right, that I'm gonna be doing this. I'll just be really good at it 10 years from now, right?
Mm.
And there's only a very small number of companies that I could work for. And further, what I learned, having been with companies like, General Electric and other large Fortune 50 companies that one would know about, I survived many of those reduction in force efforts, right? They call them reduction in force, but it's a layoff, right?
Mm.
I happened to be right place, right time, where I was never tagged in one of those, but I learned very, very quickly and very, very young, Dwaine, how fragile, a job really is, right? You were only ever 2 weeks away from financial ruin if you're living paycheck to paycheck, right? Because that's
Mm-hmm.
as secure as any job really is. So came to that realization in my 20s, right? And right around the time that I started trying to figure out, why are my wife and I grossing a lot of money, right? We're paying half of that in taxes, right? Because we are double income, no kids at the time, right? And further, also learning that all we're doing is buying a bigger treadmill every time we go. You make more money, you'll go buy new things, right?
Mm-hmm.
And so we started to have this realization of, good Lord, we're not any better than we were 5 years ago. We make more money, but
Mm-hmm.
we're not any better than we were 5 years ago. We still have student debt. We still have, half our money going into a 401k that's making 7% or something, not exciting. And we just weren't getting anywhere. So right around that time, the patriarch of my family passed away. Okay. I won't go into the details of that story, but it was heart wrenching for everyone. He was a big Texas man, life of the party. He's still teaching me things to this day, now that he's been gone several years. But what I learned at the time, this also coincided with, his passing coincided with asking the question, wow, we're not really getting anywhere. How do you create wealth in this country? And so I had started studying what the wealthy people do. Like, what is this mystical 1% people talk about, right? What do they do to get there? And the more books I read, I started to find common denominators in real estate, like dating back to king and queen times in ancient England, like go back to Babylonian times. People were paying rent for land back in the day, right? Excuse me, I just hit the microphone. Well, my grandfather passes away, and I discover, okay, well, he has been, running a rental, community in Central Texas. And so my now business partner, two of my business partners are family, by the way, we can get into that. But my partner, Kim, who is our operations and asset management lead, she took over the family business at that time. And within 12 months, while I'm trying to figure out how you build wealth in real estate, she takes a business that was doing all right and increased it in net profits by 140% in 12 months. And if your listeners know anything about cap rate or sales comps, right? Yeah, that income goes up. Well, guess what? The value that property goes up too. So all of a sudden eyes were opened, and it was like, wow, there's something to this. Right? So then the question is, how do we replicate this, right? And education. We went to all the boot camps we could, read all the books we could, and figured out, okay, the best asset class for us to be in this time, in this current, environment with the supply and demand that is situation that is present, is apartments. It's multifamily real estate, right? And so we started acquiring those ourselves first, and then quickly started scaling into bigger buildings, because it's actually, more profitable. It's the same amount of work. There's just more zeros behind the result, right? As you get to bigger ones. So that's really how we got going, Dwaine. And it was actually a funny transition. I had it all figured out. I mean, I'm head of household. Like, I'm not going to do one thing or another thing. I'm going to do everything. Right. So I had a big corporate job. It was not a little job at the time that I left. I was a global supply chain and commodity leader for a Fortune 50 company. I traveled probably 50% of the time out of the country. Right. I had teams in Europe, Asia, and China. And Europe, Scandinavia, and China. And so I had the benefit of working from home. I had the benefit of being able to work early, because China is 12 hours opposite me, and European regions and Scandinavia is 7 to 8 hours ahead of me. Right. So I had the ability to start working at 4 or 5 a.m., work until about noon, handle everything I needed to handle for my job, right? And then spend the rest of the American day working on my business. That's awesome. I did that very well for a long time, until COVID happened. And all of a sudden I had a 2-year-old at home, and all of a sudden my wife was at home as well with her job. So we're 2 working parents with a toddler. And then all of a sudden, global supply chain was also very upset by the pandemic, right? So I could see this coming a mile away before it got to the US. So that was requiring more time. Real estate was requiring more time because of all the uncertainty at the time. Fortunately, our buildings did very well, but nobody knew if everyone was going to pay rent. Nobody knew what stimulus checks were. I mean, there was, just take yourself back to remember what everyone felt like, the confusion, the chaos. just 12 months ago, you know? And that's what we were navigating. So it didn't take me long to realize, wow, I don't have enough hours in the day for this anymore. I'm just gonna, and it was a ballsy move, but I broke away from corporate America right in the beginning of the pandemic, and cut off a spigot of 6 figures of income. So
Wow.
here we
Wow.
are.
Good. Yeah. Good for you. And like you had mentioned, you had the little one with the wife at home, and also she was working. So you kind of
That's right.
balancing all and kind of saying, hey, what is more important? You're traveling 50% of the time, and you may have that more of that realization. It's good that you kind of had kind of the wheels in motion where you kind of was balancing both your corporate and your new business, which was like a good segue instead of kind of going cold turkey and scrambling around. Plus you had the education, so you had like all of the elements in
Right.
place to make it happen. So kind of fast forwarding today, as you kind of continue to grow the company, where kind of your assets located as far as kind of markets, and then what attracted you to those markets?
Yeah, so I'm really glad you asked that, because I'll say market research is kind of a thankless job, right? It's something that we have to do and we should do, because all properties are not created equal. If we're going to go buy a value add asset where we have the opportunity to renovate and upgrade a community, right? The quality of a community and the people in it, would we rather do that in a market where the water is also rising organically, right? Or would you want to do it in a market where the water is falling, right? Where things are not improving. So we tend to play in the southeastern portion of the US. If you study macroeconomic trends and macro demographic trends, you will find out that the majority of migrants are actually, around this country and from internationally situations are coming into the southeastern part and Texas of this, of this country. The reason is taxes are lower, the business environment is friendlier, cost of living is lower, and the economically the jobs, a lot of the manufacturing tech, like a lot of those hubs that were formerly in California or the Northeast or something like that, or Washington, right? They have gotten fed up with the local business environment. That's what happens when you start taxing a business, they leave, right? And so we have tons of Amazon headquarters. We have the cyber capital of the world down of the military down here. I mean, just I could go on, right? So we also don't like coastal regions, because insurance is we could do a whole episode just on insurance right now, but insurance is a very unpredictable thing at the moment. And we need to make sure that we are staying where our expenses are predictable and hopefully decreasing if we can help it. So we stay off the coast, right? So that really leaves only a couple of states in the Southeast. We own property in Texas. We own property in Tennessee. We own property in Georgia. We are trying to own property in Alabama. We don't yet. And we kind of have our eye on the Carolinas, but everyone else does as well. So we don't really play there. We prefer to play in strong secondaries that are not the big sexy market, but they're strong. They're supported by the big sexy market, right? And therefore, hopefully competition is a little bit lower. Cap rates are a little bit less compressed. And so that's where we are.
And it kind of dealing with, you had mentioned like, the Carolinas where everyone is looking there. And of course it's sometimes can get pretty competitive. And as we, kind of hopefully on the tail end of the pandemic, how are you now looking at deals a little bit differently than you did a year ago, in regards to like stress testing and kind of doing scenarios to make sure that, at whatever scenario happens, you'll be able to, withstand it and, succeed in your project?
Yeah, that's a great question, and it has evolved over time. I don't know if it's all because of the pandemic or just because of the environment today. I'd never heard of an occupational audit. I mean, everyone's heard of a lease audit, right? You go through and you check all the leases and make sure they match what's on the rent roll. I had never heard of an occupational audit, but all of a sudden lenders started asking for it, and so we kind of perfected the art of matching up the resident to the job that they, from their application to the job that they have, the income they're making, how susceptible that industry is to layoffs, right, in the current environment. So we started kind of evaluating risk like that. So for example, if you have a complex that is Class B and has all tech industry workers, you're probably fine because they're always working from home anyway, right? But if you have a complex that is maybe Class C and it is primarily people working in the, let me just pick one, food industry, right, where they're working on the assembly line or the manufacturing line, a lot of those places got shut down and people just got laid off. Or if you're working in, if you have a lot of restaurant workers, right? We've never had a problem with this before, but it's something you have to watch. So you have to really kind of balance what your your resident base is in those buildings. Economic vacancy, economic vacancy, economic vacancy, economic vacancy. I can't say it enough. Did I say it 3 times? Economic vacancy. Okay. Like, people look at deals are marketed based on physical occupancy. It's like, well, that's great. Okay. You're 99% occupied and you have been for 5 years. Show me how many of those tenants are paying rent, right? Because what you have to start doing, you have to watch the financials of the property for definitely through the pandemic, and see, how has delinquency stacked up? How has bad debt stacked up? That's money that you cannot collect and you wind up writing off. You also have to look at the rent roll or the accounts receivable report, wherever it would be. But, where are those balances stacking up? But can you just see that people's balance on their account is just stacking up month over month and not getting any better? Once they get beyond 2 months behind, they're not catching up. You might as well just write it off, So making sure you're not paying for a property that is fully leased up and seemingly performing well, but actually has 70% economic occupancy because 28% aren't paying,
Yeah,
so
very
understanding that has been very critical. And I'll tell you one thing that I don't think a lot of syndicators have picked up on, or even just operators, right? Costs are up. Construction costs are up. What I could buy a set of appliances for just 6 short months ago is not the same, right? So you need to be building that in, when you're looking at how much it's going to cost to get something done, and think about how long it's going to take to get something done. We've even had to, some of our projects, we said, you know what, we're not dealing with supply chain anymore. We have a lot of cash here. We're just going to go buy 50 sets of appliances and put them in a storage unit, right on the property. Just bring one of those portable ones on the property. And we pulled from that stock. So that's sometimes you have to get creative and think about supply chain and logistics a little bit, because you have a unit go down that needs a refrigerator. You can't wait, 12 weeks to get a refrigerator, right? It doesn't work.
Yeah, those are some great points there. And a lot of stuff that people are not thinking of, and
it's the details, man. The devil is in the details.
And I bring that up because as a limited partner, and you're looking at working with a syndicator and investment, if they kind of explain to you their process of looking at deals, so they know that they have just like a general business plan of, okay, we're gonna kick out bad tenants, we're gonna increase the rent, we're gonna do rental a couple units. But if you kind of explain, like, this is the thesis and how we look at things, because you mentioned a lot of stuff that probably some people definitely would overlook in their analysis. And since now we have about 12 months of data of going through a pandemic and some practice where people can say, have we withstand properly? You guys definitely, thought about all of the little details, which, would definitely benefit you and others that would listen to the show in the future.
Yeah. And there's one really key point that I'll get to here, and then we can move on to the next question. But, rents are going down, expenses are going up, and we're not going to make that much money, said no deal sponsor ever, right? Every pro forma you look at says things are going to be great. We're going to go in and put granite countertops on things, and we're going to kick people out. We're going to raise rents, right? That's what everyone says, right? And that's not the way that things are actually going to play out, right? You're going to want to keep some people there that are good tenants, and maybe you don't hit that maximum rent. Maybe you go after, something, a reasonable increase, and you keep your occupancy up. You keep cash flowing, right? Every property has its hit list of people that need to go, right? But for the majority, they're just people trying to live life, So we don't underwrite to the maximum, right? Like, if I think that a property is on average below market $200, I'm not going to assume I go get all that in year one, right? And I think the other key is, and we do this differently than most people, like, cash flow is important, and everyone underwrites to cash flow. And they say, okay, money in is the investment, all the cash flows go out, and then we sell, all the proceeds go out, life is good. That's your return, right? Well, not exactly, right? This is a living, breathing business. Every single building, apartment community you buy is a living, breathing business. They need a living, breathing business needs blood to flow, right? You need blood to live, right? Well, cash is blood. Okay. Cash flow is the flow of blood. So if you don't have that, You can't just, we actually go in with a lot more cash in the bank than most people do, because the only way you get in trouble is you don't have enough reserves to weather a storm, right? If you get over budget, if you can't pay your loan, that's the only way you lose in this business, right? You
Mm-hmm.
might sell lower than you want to,
Mm-hmm.
but the only way you lose is you sell when you're not ready to sell. And the only reason you sell when you're not ready to sell is because you're out of money, right?
Mm-hmm.
So that's probably the biggest thing I can tell to people. I think we do that a little bit differently. I want to say there's other good groups that do that as well. I've seen a lot of pro formas that are cashed in. We're going to go in with more money on the front end, in the bank, and that might lower what a pro forma looks like. And someone else might show you a 25 IRR where I'm showing you a 22, right? But I'm going to hit that 22, and whatever money, that excess money we don't spend, it just comes back to you later as part of your
Mm-hmm.
return, right?
Mm-hmm.
So that's the biggest thing that I think people need to look at if you're looking to invest in a deal, if you're trying to sponsor a deal, make sure that the sponsor not only has a handle on the cash flow, but what the cash position will be throughout every year, right? Because if they're not looking at that, they may wind up overspending and getting too thin and projecting they're going to distribute money that you can't distribute. So,
Oh yeah, totally. Yeah, totally agree there. Because me, as a passive investor, I always want to look first and foremost capital preservation. Of course, at the same time,
right.
cash flow and building my wealth. So, if all of those elements in place, and of course, good tactical plan for the investment, then that's all good. Checking those boxes. So glad
And
that
you
you
mentioned
guys do
stress
that.
tests. You mentioned stress tests as well. I mean, that's a really simple one. We look at two stress tests. One is how much economic vacancy can I have before I can't pay my interest or my loan and my taxes and insurance, right? Because that's where you get in trouble with the bank, the government, or the insurance company, which gets you in trouble with the bank, right?
Mm-hmm.
And you want to make sure that I make sure that's at least 40% away, right? So you can live for a while. Now nobody's getting paid if that's happening, but you can
Mm-hmm.
live, right?
Mm-hmm.
And then you look at just what is break even occupancy, and that you like to see that better than 20-25%, and that gives you margin to operate. You
Mm-hmm.
know,
Absolutely, absolutely. Yeah, great points. And like I said, we can go probably another hour on just kind of
oh
the
yeah.
nuances and details. But
Sorry, Dwayne,
yeah,
you got me going.
hey, well, it's your passion, right? So, but yeah, we want to kind of get to know you a little bit more. Can you kind of take us through, with your new typical work day, and do you have any special morning routines?
Absolutely. So I'll say I kind of go back and forth between the Miracle Morning, and that's Hal Elrod is the book you can read. I know a lot
Mm-hmm.
of entrepreneurs love that. Hey, businesses are built before 6 a.m., I say, but I pay myself first. It's something that I learned a long time ago. So, and I typically get up and will do my miracle morning routine, which is for me, that's like, I like to use 4:30 to 6:30 as high brain work, right? Like just, I need to concentrate on this. This is like high value work, right? I get up and do that, and I don't do it every morning, but some mornings I don't. But I definitely get involved with getting my kid ready, taking my kid to school. 6:30 to 8. Then from 8 until 9:30 or so, I either go to Golf Tech and work on my golf swing in front of the simulator. I go to the gym and work out. Like I pay myself first, right? So then by the time 9:30 rolls around, I have accomplished more in my day than most people will all day, right? So from there, come what may, right? Bring it on.
Mm-hmm.
After that, it can all go to, wearing a handbag. But after that, I do spend I schedule a little quiet time to do a little more quiet work before like 11. And then from 11 to probably 4 or 5, I'm involved with my team in various meetings, right? I might be walking a property. I might be, coaching my acquisitions team through something we're looking at. I might be on a board meeting with the rest of my managing partners, an partner call for a property. It just, whatever happens between those 11 to 4 or 5
Mm-hmm.
hours, right? And you know what, guys? I shut it off. I do my best to, but I usually shut it off when my girls get home. I close the door, put the phone in here, leave the phone on my desk, and I shut it off. And then, depending if I got up in the morning at 4:30 or not, I will either go to bed after when the girls do, or I will stay up and work until about 11 or 12. And you don't have to do this much. It's just what I like to do, right?
Mm-hmm.
I'm an achiever. So yeah, that's pretty much it. But I mean, look, lifestyle by design, design your day. I pay myself first in the morning. I carve out family time. I could always do a better job at that. But I also love this business that we've created. So I do
Hmm.
love, it's not work to me. It is intriguing problems to solve.
Awesome. Yeah, yeah, I love to hear that. And you had mentioned communicating with like your partners, the team, acquisitions, property managers, and all that stuff.
Mm.
Can you kind of talk to us about any tools or resources that you use to make your day more productive?
Oh yeah. So we use a project management suite called ClickUp. It is, I
Cool.
think clickup.com is the app. It's kind of like an Asana, if you've ever heard of those, but
Hmm.
it is a big team oriented, like we can message each other. We can, it's got projects and tasks and calendars and Gantt charts and you can really just like go, it's intimidating at first, but if you take the time to learn it, it is a really great way to stay organized and like collaborate on things. So between that and Google's G Suite, for like Gmail and Google Drive and all that, all those things work together, and those are kind of our productivity suites, right? Because we don't sit together. We're a very tech savvy company. We sit,
Hmm.
I've got partners in Texas, partners in the Northeast, partners in Tennessee. So we're all over the place. And the other thing we've discovered that I really like is an app called Loom. And it is actually you can get it on your phone or on your computer, but just like I'm talking to you right now, I can record myself talking on my screen, and it uploads to the cloud, and I can just send a link to whoever it is, like in an email or something. And instead of me spending 30 minutes typing out a detailed email because I can't get a hold of someone, I can talk for 2 minutes, right? And point and click and all that kind of stuff. And they can watch that. And 90 seconds later, we have transference of information, right? So it's a
Awesome.
very, very good tool.
Awesome. Yeah, that's really cool too. Yeah, because every time I ask them, I always get like a little extra tool or app and stuff that I haven't
Yeah.
realized that that's out there that's helping other people. So that's great.
Oh
And
yeah.
then finally, with all your success and kind of like your journey, what can you say that you're most grateful for?
What I'm most grateful for, I mean, you have to lead with the love of family and friends, right? Because without that, what are we doing?
Hmm.
I think uniquely what I'm most grateful for is wherever I got it, I got some kind of work ethic, right? And I got some way to look at numbers and spreadsheets and plans, and I'm able to look at this stuff with an engineer's view. And it really, when I can marry that to some decent social skills and communication skills, and a work ethic, like something pretty powerful happens. So I'm very grateful for those three gifts that I've been given, because it's really enabled me to look at things differently, to communicate in a way that people can actually relate to, and to have the drive to get it done, right? Because this is not, it's not all rainbows and unicorns in this business. I don't care who
Oh
else
yeah.
says it, but there's hard times, you know.
Hmm. Absolutely. Oh, very well said. I really appreciate that. And finally, what is the best way to get in contact with you?
Yeah, so I'm sure you can put this in the show notes as well, but the best way would be to go to our website at thequattroway.com. And I think if you guys are seeing the screen, Quattro is spelled Quattro. So thequattroway.com, you'll find bios, videos, all that kind of stuff on myself and my partners, assets we own, as well as how to get in touch with us.
Awesome, Chad. It was a pleasure to speak with you. Like I said, love talking to like-minded individuals, and love that you designed your business around your family and your passion and your people that you love. I really appreciate you, sharing out some knowledge, and look forward to connecting with you again soon.
Yeah, Dwayne, thanks for having me. I really appreciate it.
All right, take care, my friend.